Types of inventories. There are three types of inventories in regards to manufacturing account: raw materials, finished goods, work in progress. Raw materials can be further classified into opening inventory of raw materials, which should be transferred to manufacturing account under the section of direct material. Opening inventory of raw materials gets added under direct material. Secondly, closing inventory of raw materials. Closing inventory of raw materials once again is transferred to manufacturing account. It's deducted under the section of direct material. Furthermore, the closing inventory of raw materials is transferred to statement of financial position under the section of current assets. Finished goods. Finished goods are of two types: opening inventory of finished goods and closing inventory of finished goods. Opening inventory of finished goods is transferred to the income statement, and this is added under the section of cost of sales. Whereas the closing inventory of finished goods, this is transferred to income statement under cost of sales, but it is deducted. Furthermore, closing inventory of finished goods is transferred to statement of financial position under current assets. Work in progress. There are two types of work in progress. Opening inventory of work in progress goes to manufacturing account below total of factory overhead. You add this value, whereas closing inventory of work in progress once again to manufacturing account, but this value is deducted just below the opening work in progress. Furthermore, closing inventory of work in progress reflects in the statement of financial position under current assets. In order to summarize, opening inventory of raw materials, finished goods and work in progress, all three are added in respective final accounts, whereas closing inventory of raw materials, finished goods and work in progress is deducted in the relevant accounts. Furthermore, the closing inventory of raw materials, closing inventory of finished goods and closing inventory of work in progress reflects in the statement of financial position under current assets. This is a summary table in order to understand the type of inventory, where exactly it gets transferred, do we add or deduct, therefore under which section, and how does it reflect in the statement of financial position. Income statement. Finished goods are entered in the income statement. Now let's see how this can be transferred to the income statement. Opening inventory of finished goods goes under the section of cost of sales. As you can see here, opening inventory of finished goods, income statement, cost of sales you add. Therefore, go under the section of cost of sales, opening inventory, you add this value. Closing inventory of finished goods, once again under cost of sales, but you deduct this value. So you go under the section of cost of sales, closing inventory of finished goods, and you deduct this value. Furthermore, closing inventory of finished goods will be transferred to statement of financial position under current assets. Now, let's look at the entries of raw materials, opening and closing values. This is a format of a manufacturing account. As you can see here, the opening inventory of raw materials are added at the first section of your manufacturing account, whereas the closing inventory of raw materials, it once again goes under direct material and it's usually deducted. Furthermore, this closing inventory of raw materials is transferred to statement of financial position under current assets. Work in progress. Work in progress reflects in the manufacturing account. You adjust these two values just after finding the total production overhead. Opening work in progress is added, as you can see here, and closing work in progress is deducted. This closing work in progress will also reflect in a statement of financial position under current assets. As you can see here, as I mentioned before, closing inventory of raw materials, closing inventory of finished goods, and closing inventory of work in progress, all three reflect in the statement of financial position in this order under a subheading closing inventory. This is the complete format for completing a manufacturing account for Edexcel IAL Accounting Paper 1. As you can see here, we have the direct material at first, such as opening inventory of raw materials. Let me enlarge this. So we have opening inventory of raw materials, purchases of raw materials, returns of raw materials deduct, then you find the total raw materials available, deduct closing inventory of raw materials, therefore you find cost of raw materials, any manufacturing wages should be added, royalties should be added, and direct expenses added. Now, by taking the total of all these figures, you find the prime cost. So prime cost is the total of direct material, direct labor, and direct expenses. Once you had figured out the prime cost, production overhead. There are ample amount of examples under production overhead or indirect expense. As you can see here, there are few examples: management salaries, indirect expenses, rent and rate payable, insurance, power and water, depreciation of machinery, manufacturing machinery, depreciation of any computer equipment used under manufacturing. These all values should be added. Thereby, you find total production overhead. Now, prime cost plus the production overhead added in order to find the total cost, which is an addition of prime cost and overheads. As we discussed before, add opening work in progress, deduct closing work in progress, adjustment for work in progress. Sometimes this value can be a negative value. In that case, you use the brackets if the closing work in progress is greater than the opening work in progress. Now we have the total of prime cost and overhead. With that, you adjust for the work in progress and you figure out the cost of production. If any profit on manufacture is given, that needs to be added in order to transfer the value to the trading account. Now, this value should reflect in the income statement. So, effect of profit or loss, factory profit on statement of profit or loss and other comprehensive income, revenue, take away revenue, returns or sales return in order to find the net revenue. Less cost of sales, opening finished goods of inventory, plus any cost of production that we figured out from the manufacturing account, less closing finished goods of inventory, find the cost of sales, and then the gross profit, the factory profit that we found in the manufacturing account, plus decrease in provision for unrealized profit. Add these two to the gross profit, and then you continue preparing your income statement. As you can see here, factory profit, profit on manufacture, you enter it under gross profit under other income, and the cost of production value reflects under cost of sales. Take few minutes to reflect on how the figures are transferred from manufacturing account to an income statement. Manufacturing profit. For accountability purpose, some businesses treat their shops and factories as two separate cost centers. As a result, some businesses transfer their products from the factory to the cost of sales in the statement of profit or loss and other comprehensive income at the production cost. This replaces the purchaser's entry in the cost of sales. Remember, the manufacturing business has purchased raw materials, not finished goods for resale. In this case, the transfer is easy to account for. Simply use the figure for the cost of production and insert it into the cost of sales after opening inventory of finished goods. Manufacturing profit. However, some businesses will add an assumed factory profit to the cost of production calculated in the manufacturing account. This profit is calculated using a percentage markup on the production cost. This is then added to the cost of production to obtain a transfer price. It is this transfer price that is now used in the cost of sales calculation in the statement of profit or loss and other comprehensive income. In the worked example from earlier in the chapter, the cost of production transferred to the trading account is 50,080. So let's assume the cost of production is 50,080. If the business has now decided to add a factory profit of 20% before the goods are transferred to the last entries in the manufacturing account would be now. So find 20% of 50,080, which should give 10,016. Add these two figures in order to find the transfer profit. Manufacturing account would now be the transfer price of 60,096 moved to the cost of sales in the statement of profit or loss and other comprehensive income. As you can see here, therefore, the production cost should be 60,096. Look at this example of unrealized profit resulting from goods manufactured. This is another key area tested in the past papers of paper 1. Factory profit. When preparing financial statements, the factory profit included in closing inventory overstates inventory value. According to the realization concept, profit is only recognized when goods are sold to customers. Factory profit in finished goods of inventory is not yet realized as goods are still within the company's system. According to the realization concept, profit is only recognized when goods are sold to customers. Therefore, factory profit in finished goods inventory is not yet realized as goods are still within the company's system. Number 2. Closing inventory and unrealized profit. Any closing inventory in cost of sales includes portion of factory profit. The unrealized profit must be removed to prevent overstating both inventory and the profit. The formula to remove unrealized profit is markup percentage over 100 plus markup percentage into closing inventory or value. Now let's look at this example. Closing inventory is £24,000, factory profit 20%. Therefore, let's calculate the unrealized profit. Plug in the figures to the formula. Therefore, 20 over 120 into 24,000 equals 4,000. Now, record this as an expense and deduct it from inventory. Look at the second example. can you calculate the unrealized profit? Your closing inventory is 15,000 and factory profit is 20%. Take a few minutes to calculate so that I can show you the answers to reflect on your answer. Let's check. Did you get the answer 2,500? So 20 over 120, which is 20 plus 100, 120 into 15,000, the inventory value, which should give 2,500. Right. So let's see how this is transferred to the statement of financial position and how we prepare a provision for unrealized profit on manufacturing goods ledger. Now look at this example. So in year 1, we had unrealized profit of 4,000. In year 2, we had an unrealized profit of 2,500. Basically, it has reduced. This represents a decrease in provision for unrealized profit. It was 4,000 and now is 2,500. It is only the difference that is accounted for in the statement of profit or loss and other comprehensive income for the current year. Therefore, the difference between 4,000 and 2,500 is 1,500, a decrease. This represents other income and is entered after the gross profit as an addition to the profit. Suppose if it was an increase, this should be entered under expenses. How will this reflect in a statement of financial position? Under current assets, you write the inventories less provision for unrealized profit if there is a decrease. For the one that we calculated for year 2, this value of 2,500 should be adjusted for the current year statement of financial position, not the amount by how much it decreased. Only the closing figure for the current financial year will be reflecting in the SOFP. As you can see here, we have a closing inventory of 15,000. From this, you deduct 2,500 unrealized profit for the current year. Therefore, the total of inventory for the current year should be 12,500. How do we prepare the ledger? As you can see here, so at the start of the year, a credit balance of 4,000. At the end of the year, just like we prepare the provision for irrecoverable debt, carry down, brought down, debited and credited 2,500. Credit side is greater, bring it to the total. From that, deduct 2,500 in order to find the value that should be transferred to the income statement. Now, this is the impact in the statement of profit and loss and other comprehensive income. As you can see here, since there is a decrease of 1,500, and while we prepared the ledger, the difference appeared on the debit side of the ledger of provision for unrealized profit. This should be transferred under other income just underneath gross profit. Suppose if the difference appeared on the credit side, you simply write it as an increase in provision for unrealized profit, and this should be entered under expenses. In this example, we have a decrease, therefore it's a profit on provision for unrealized profit. Now look at this example. Now we have an increase As you can see here, in year 1, we got the unrealized profit on inventory 3,600. In year 2, it's 5,600. This means it has increased by 2,500. How will this reflect in the statement of financial position? Inventory for the current year is 28,000, less the current year's unrealized profit of 5,600 deducted. Therefore, the total inventory value should be 22,400. Let's prepare the provision for unrealized profit on manufactured. At the start of the year, it's 3,600, credit that value. At the end, it's 5,600, carried down debit, brought down credit. As you can see here, the credit side is greater, therefore the total should be 5,600 on the debit and then on the credit side. Now the difference between 5,600 and 3,600 is 2,000. Now this value should be transferred to income statement. As you can see here, the difference appears on the credit side of the provision for unrealized profit. We should enter this in the income statement under expenses. Now this is how it reflects. This is the format of an income statement. So you have opening finished goods, any cost of production you transfer, less the finished goods of inventory, whatever you had, you transfer it there. And then this difference that we get here should go under the expenses as a decrease in provision for unrealized profit.